Hello. In this video, we'll be going through the statement of cash flow, additional issues you might see with balance sheet items. Here's an overview of what the statement of cash flow is. To recap, the statement of cash flows shows all the cash inflows and outflows that occurs during the period for a corporation, and it's broken up by three different types of activities. We have the operating activities. The most common type of cash flow statement that you will see uses the indirect method, which starts with the net income that we get from the income statement, which is based on the accrual method, and it makes adjustments to income statement accounts and balance sheet accounts to get to a cash basis net income amount. Next, it also breaks out the investing activities, which are purchases and selling of different types of long-term assets, typically. And then we have cash flows of financing activity, which tells us every cash inflow and outflow for the year from all those activities. By now, you should be familiar with how the statement of cash flow works and how it flows and what it looks like and what it's telling us. If you don't, please go see the appropriate prior videos to help clarify that. When we're talking about the indirect method, as you can see here, when we're talking about the indirect method for the operating activities section, we have the net income, adjustments for non-cash income statement items, but then we also have these adjustments for changes in operating assets and operating liabilities. As you can see with this particular cash flow statement, these are kind of more the standard or typical balance sheet items that you will see that are adjusted in the cash flow statement, such as we account for accounts receivable and changes in inventory, accounts payable, salaries payable. There are, however, some other types of balance sheet adjustments that we need to consider, which may or may not have an impact on the statement of cash flows. The first balance sheet item we're going to be talking about is the allowance for uncollectible accounts. If you recall, the allowance for uncollectible accounts is a contra asset to accounts receivable. And in this account, we record the amounts that we don't think are going to be collectible from our accounts receivable. And then also the amounts that we actually end up not collecting are also adjusted through this account. So first, the allowance account increases by the adjustment to bad debt expense made at the end of the year. So this is how we account for amounts of our accounts receivable that we don't think is going to be collectible. We debit bad debt expense and credit the allowance account. And then when we have actual write-offs in each year, whether we end up collecting an amount that we didn't think we would, or we end up just saying, okay, we're never going to collect this so we can write off our allowance, we write it off each year through this allowance account as well. Okay, so let's go through a quick example. Assume that UBC's balance of allowance for uncollectible accounts increased by $5. Increase indicates the company recognized more bad debt expense, which is a non-cash expense, than the accounts that were written off, which means that within our net income number, right, if our net income was $120, we have $5 more bad expense in this net income number than we actually wrote off. So we need to increase our net income number by that $5. So when we look at our allowance for uncollectible accounts, if we have an increase in our allowance for uncollectible accounts, we're going to increase it's going to be an adjustment in the operating activities, increase in allowance for uncollectible accounts. So we're going to start with a net income, and we're going to increase it for the uncollectible account. I want to note that we put in here, we also are showing the adjustment in the gross receivable, which we didn't go through in this video, but we have in a prior video when we talked about the indirect method. And that's because some of the uncollectible accounts flow through the accounts receivable. So you kind of have to show both of those line items to get a full idea of the full amount of cash that we've received from sales, less amounts uncollectible cash on the cash basis. So you kind of have to show both of those to show the net sales that we actually received. So also, I want you to think about allowance for uncollectible accounts is a contra asset account, and its regular account balance normally is a credit balance, much the same like a liability. And we've learned in prior videos that when you do these adjustments, balance sheet adjustments, if you have an adjustment to liability, like you have an increase from the beginning of the year to the end of the year, if you have an increase in your liabilities, then you're going to add whatever that increase is into the net income amount, which is what we've done here. Our allowance for uncollectible increased for $5, and so we're going to add it back into our net income. Another type of adjustments we have to watch out for in the balance sheet is amortization of the bond premium or bond discount. In this example, assume UBC had issued bonds at a discount in a prior year. During the current year, cash paid for interest was $8 and amortization of the bond discount was $2, which means that the interest expense would be $10. If you recall back to when we learned about bonds, a bond can be issued at a premium or a discount. And if it's issued, let's just say in this case, at a discount, that discount is amortized over the life of the bond based on the number of interest periods being paid. So the amount that we pay in cash for interest is not the amount we record as interest expense. But in this situation, here we go. It says that we paid cash for interest was $8. So we credit cash for $8, and the amortization of a bond discount is going to be a credit. So we credit discount bonds payable for $2, which means that the interest expense is $10. Now this interest expense reduces our net income by $10. So if we had income of $130, it would get reduced by this $10 of interest expense to get to $120, right? But only $8 of it was actually paid in cash, so we would have to add $2. So whatever your basically your amortization of the bond discount is what it ends up being, has to be added back to net income to get to the cash basis net income number. And this is how it would be reflected. You would start with your net income, and you have adjustment for the decrease in decrease in discount on bonds payable. Here, this bottom bullet says the opposite is true. If we had a bond that was issued at a premium, right, it was sold at above its face value, then we would have a bond premium that would be amortized, and it would go the opposite way. Lastly, last type of balance sheet item I want you to be aware of is deferred tax assets and deferred tax liabilities. When we record an income tax expense, that income tax expense can encompass the current year liability that we have on our tax return, but can also encompass deferred tax expenses for liabilities that we might have in the future or future deductions if we have a deferred tax asset. So here's an example. UBC had income tax expense of $40 and a decrease in income tax payable of $20. Assume that part of the income tax expense of $40 included an increase of $5 in deferred tax liability account for the year, which means that a payment of this $5 is deferred to a later year, and the total income tax paid in the current year would only be $55. So our let's see. So here is the entry that we would record for this. Just based on what they told us, they told us the income tax expense was $40. It told us that income tax payable decreased by $20, right, for the year. So we would debit income tax payable. It told us that the cash paid for income tax was actually $55, so credit cash, which means that a deferred tax liability has to be recorded for $5. So when I look at my income tax expense is $40. So again, when I'm looking at my net income, I started with 160 and I reduced it by $40 for my tax expense to get to 120. Well, how much was actually paid in cash? It was $55, right? So my income, so if I start here with my 160, I should have a $55 deduction. So that brings me to 105. So my net income on a cash basis should be 105, not 120, right? So let's just see how they do that on the statement of cash flows. The way it's done is that we are going to subtract the decrease in our income tax payable, because that's just a regular current liability. And if the payable decreases, then we go in the same direction on our statement cash flows. So here's my decrease in income tax payable, but now I had an increase in deferred tax liability, which guess what is also a liability. And because when we know that when a liability increases, the adjustment is going the same direction. So the liability increased, so we're going to increase our net income by $5. And guess what? When you take the 120 minus 20 plus 5, you get the $105 of net income on a cash basis, which is what we had up here beforehand. I erased just because it was too messy. It was too much writing. But this is how you can adjust for deferred tax liability. You just follow the same logic that we learned in the indirect method video, that when you have an operating liability, right, then whatever way the adjustment goes from the beginning of the year to the end of the year, it goes in the same direction. So if the liability increased that year, then you have that same increase amount to increase your net income. If you had a decrease, it goes in the same direction and decreases it.